Good morning, everyone, and welcome to the Joint Venture Audit webinar presented by Hein Associates. I'm Jennifer Nichols, your moderator and web organizer today. Before we start, let's take a moment to cover a few housekeeping items. All audio lines will be muted, so please use our chat feature to ask questions. We will save time at the end for Q&A. This event is being recorded, and a link to the recording will be sent out to all registrants later today. Your active participation is important throughout the session. In order to receive CPE credit for this session, you will need to be connected for a minimum of 50 minutes and must answer 75% of the polling questions included throughout the presentation. Immediately following this webinar, you will be directed to a survey page where you can leave comments. Please check your inbox later today for a follow-up email that contains an evaluation form that must be submitted in order to receive your CPE certificate for the course, a link to the webinar recording, and presentation materials. Our presenter today is Deanna Duell-Smed. Deanna has more than 18 years of oil and gas industry experience and currently serves as a managing consultant on the Business Advisory Services team at Hein Associates. Her focus is in managing operational accounting non-attest engagements for E&P companies. Her responsibilities include managing JV audit engagements for non-operators, having an interest in operations, and advising her clients on audit requirements and outcomes. She also manages consulting engagements for clients who perform operations to provide essential guidance in accurately billing and paying non-operated partners in the JOA. As a result of her active engagements in the oil and gas industry at the firm and her years of diverse professional experience, she understands the inherent challenges for companies in accounting. Due to her qualifications and experience, she holds a designation as a Chartered Global Management Accountant through the AICPA. Thank you all for attending today, and I would now like to introduce Deanna.
Thank you, Jennifer. Good morning, everyone. Thanks for joining the webinar this morning, and we're going to cover three primary objectives. Overlooked operator billing opportunities. So from the operator perspective, we'll get a little into why it's important to consider how operators are billing and to take a look at your own billing results and in terms of preparing for potential joint venture audits in the future. Also, we'll talk about a recent JV audit uptick that we've seen here at Hein in our practice area, as well as establishing a consistent JV audit program. To get started on overlooked billing opportunities, it's important to first, take a step back, look at what the operator goals are in a joint venture. And effectively, they want to have operations that run well and efficient. They also are interested in their recovery of expenditures when it comes to the partners. They have an overhead component that assists them in their operations, and they also share the rights and obligation of the well. So keep in mind that this is in the framework of a joint venture in sharing risks and rewards. So in a joint venture, the accounting is typically handled in the context of the joint operating agreement and the COPAS accounting procedures thereof. Understanding the challenges of the operator, and this really kind of goes back to the recent shale boom. There was a lot of aggressive drilling schedules, time constraints, and tracking complications came up. We did capture an article out on our website that you can take a look at, and it's highlighted here. It talks about the equipment movement and the exposure to the operator and the non-operator in this area. Also, COPAS recently approved the materials manual in San Diego this fall 2016 conference, and the publication can also be purchased through the COPAS e-publications. So I encourage you to take a look at the new materials manual because that really is comprehensive, and it has taken a lot of different publications and merged them into one to make it user-friendly as well as comprehensive. We have performed a number of desk audits for clients who are operators, and that was in order to help them improve processes and keep the exceptions down as they continue to see non-operator audits persist over time, and we'll talk a little bit about that. But at the end of the day, costs have been really going up on a lot of wells over time, and I just wanted to give you a sense of the increase in cost versus, just the normal inflation rate, and that gives you some perspective in terms of, why it's important that companies take a keener look at these costs. The per well rate, and this is inflation adjusted, the per foot rate was a lot lower back in '60 versus what we're seeing nowadays with added technology and a number of drivers that would cause our costs to go up. We're drilling deeper, we're going further, and it's just ultimately culminated in higher costs. Operator billing overhead, another article that we have out there on common mistakes that we see in the joint venture audit program. It's the operator's way of recovering their costs that are not directly chargeable per the joint operating agreement. And again, COPAS is a go-to resource where I encourage you to get the e-publications, but specifically in that article we talk about the different, the AG and MFIs that are associated with it, such as overhead negotiations and calculation. I mean, specific to that, we see a lot of companies or a lot of landmen just pick a number, pick a rate, and really there can be more thought that goes into how that rate gets determined. So accounting really should play a role in determining what the rates are in order to basically cover the cost for the operator, instead of just going with some pie-in-the-sky rate or just because the operator next door has that rate. So again, encouraging you to look at these possibilities in your own company as an operator to facilitate working with those landmen and explaining what rate would be more reasonable for the operations that you are conducting. Another MFI, which is model form interpretations, are out there that kind of talk about overhead, such as the overhead of the joint operations, which is MFI 21. And again, these are all out on the website, so I don't have them on the slide, but take a look at that link and you'll see the different comparable MFIs that are available to help facilitate proper accounting for overhead from the operator's perspective. What we're seeing, things that operators can do better, number one is performing reconciliations. And that's just a process of making sure that the things, the captured costs that you've got for the JIB billings are being reconciled appropriately so that your basis is appropriate. A lot of auditors come in and they do perform reconciliations, but if you're ahead of the game, you're doing those already and you're catching these things before an audit comes to light. Support charges, so again, aligning with the JOA is essential. A lot of operators might just take the perspective of, hey, we're just going to handle it this way regardless of there's multiple JOAs out there, but we're taking a stance and we're just going to deal with our costs in one specific fashion. That does happen, and there is reasons for that, but I think the best practice, if you can, as an operator, if you can work with your systems to make sure you're aligning your actual accounting procedures with what the JOA is talking about, and involving land in the discussion as well on this. If there is some amendments that need to take place or there's new information, new technologies, things that are kind of sticking points that you need the operators or the other non-operators to buy into, communication with the non-operators and making sure that they are on board with those billings and that they have approved those would essentially help support your case and and help in the long run, make sure everybody's on the same page. Vendor agreements, that's something we look at, because really at the end of the day, when we find an issue with a vendor agreement, we're helping the operator and we're helping the non-operator. They typically have those agreements in place, master service agreements or what have you, in order to bill the operator appropriately. So sometimes we find issues there. And then allocation methodology, if you have a number of wells in an area and operator is allocating costs to those wells, that methodology should be clear. It should be communicated to the non-operators. It shouldn't be a difficult thing for people to understand or agree to. And just so you have a sense of what we found in our own kind of desk audit procedures, we find a lot of issues in terms of just improvement, opportunities for improvement for our operators. And we're able to basically recommend why is it that you want to do these things, and how's that going to help you if you do get audited in the future, or at the end of the day, just kind of making sure that you're at par with your vendors and things are flowing the way they should be. One of the biggest areas of note that we find when it can be kind of substantial when it comes to our economy today has to do with the discounts that aren't being taken. Now, if they don't take a discount, if an operator does not take a discount and they pay what they pay, then they can bill it to the non-ops. But with the interest rates that you can make on money and the discounts available on, say piping or other big equipment items, it's really to the benefit of both the operator and non-operator to take discounts when you can and capture those and put those procedures in place that are going to facilitate that. Another area on the vendor side would be deposits that you provide the vendors for goods or services that are going to happen in the future. Again, you can bill those out, but tracking those deposits and making sure that any refunds are obtained for costs that don't exceed the initial deposit, that's pretty important. And I think what happens is you basically go into an agreement with a vendor and you have something done, and then it gets lost in the woodwork. You just kind of lose track of it. So getting procedures in place to help you look at what might be due you from the vendor is helpful in making sure that there's a trigger to get that flowed through to the joint account to your non-ops. Documentation support, another area where we find issues with vendors is, maybe with their delivery tickets or service dates, those don't align with what's going on at that well. Vendors deal with a lot of different operators and different wells, and so they could be working with an operator next door on a different well, and they, get a bill put to you as your costs, and those discrepancies can only be found if we have those delivery tickets and we have information such as the service dates, the work performed, and we can push that up against the well and the story of the well, what's going on with the well. Do those make sense for where the well's at? So pretty important to have good documentation supporting the invoices on the operator side as well. Another area would be rig fuel recalcs. That's something an operator should continually just make sure that there is credit due for rig fuel when there's movement to a different well pad, or there's tanks out there, that are not necessarily empty when they leave the well. So that reconciliation is helpful to determine if there's credits due back from the vendor and what those are. Operator supplied equipment, that's another area. MTs and controllable equipment. Really important to have that documentation to track what that controllable equipment is, and serial numbers are an important part of that, a unique identifier, so that credit gets provided to those wells when they move off. Other areas include field gifts, where that vendor flows maybe gift cards through to their personnel. Really, at the end of the day, there is a documentation effort that the operator should take in order to identify whether these are safety or performance-related bonuses, and make sure they're signed off by the field employees, identify what time was covered, make sure the operator signs off, make sure that it's all part of the agreement. There's an MFI out there, number 37, and I encourage you to take a look at that. That will guide you on the gifts and the performance aspect when it comes to gifting field employees. Tubular reconciliations, that's another common audit practice that we do. And we believe that there's prudent steps that the staff can perform in tubular reconciliations to make sure that the costs do get credited the well once parts of tubulars move off the property. And then finally, legal costs. That's the area that we're finding depends on the agreement, whether you can charge attorney fees, and good documentation and transparency is essential when informing non-operators of such fees. So I can't stress enough, get your non-operators on board with what you're doing, make sure that the documentation effort's there, and you should be in a better position. So in our service line, we've seen a recent uptick, and we're going to kind of talk a little bit to that, what we think might be driving it, and why, in this downturn, we might see that. And to get a sense, I just put a table out on the oil price environment and a few of the highlighted areas where we had relatively low pricing. So often when that happens, you're looking at operators trying to cut costs anywhere they can and recover costs when they can. And so really your uptick, I believe, or the uptick here that we've experienced has a lot to do with the price of commodity in the market. 2014 expenditures is kind of the window that we're at today. So we've basically, once 2016 is done, 2014 goes away. Usually you have 2 years of a look back, and that's part of what we've got to, address in 2016, and then next year it'll be rolled into 2015. Maybe not as many capital expenditures, but there will still be costs, and some of those might be even on the legal side or issues that the industry have been experiencing in the year 2015. And that's looking into the future. Revenue allocation and valuation, that is another area that we've seen become a hot item in terms of concern. And it's important that non-ops take a look at this and see what's going on and understand whether or not their checks are correct. So the concerns driving the non-ops are really, are they getting billed just to be billed so that, folks can stay employed? Is there appropriately allocated methodologies that are kind of supporting what they're getting charged? And overall, the sense that we get is that there's a lack of transparency. Again, keeping the lights on, are they approaching bankruptcy? What's going on? So that's some of the drivers that we see.
Okay, so we have our first polling question. Has JV audit activity increased or decreased over the past few years? A, increased, B, decreased, or C, not sure.
So the results of the polling, the majority of those on the line chose increase. And that's the case with our service line now. I don't know about the market in general, but I would have a sense that it's probably the case out there that JV audits have increased and will continue to do so in the near future. JV audit concerns and results. We'll share some of that from our service line perspective with you today. And what I've highlighted here are kind of the key areas of what we're finding, questions coming up on, and we'll kind of dive into each of those areas. On the tubulars, the reconciliation procedures, that's, again, we talked about that from the operator perspective, but understanding kind of what's left, what's remaining, what needs to go away. We're seeing that there's been acquisition of tubulars and they're not being used, or they've been used and some of it's moved off but not been credited. There seems to be lack of procedure in place by some operators when it comes to their reconciliation process. Also, the wrong well can get charged for the reconditioning costs of the tubulars when they're being used, and then condition pricing is not always accurate. So those are kind of the areas that we find are concerns in the process of joint venture audit. Equipment concerns, basically we use wellhead schematics to identify what equipment costs we would anticipate seeing on the well and what would remain on the well once the drilling and completion activities are done. So if there's equipment that's not part of the well that needs to be credited to the well, that's what we'll find with a lot of our wells, that it just didn't happen or doesn't get done. Some of the major equipment that goes on site include tanks, separators, dehides, meter, compressors, LAC unit. And again, back to COPAS, the new materials manual is going to be really essential, I think, to help a lot of operators in this area, as well as the non-op side. What we're seeing, again, is issues with tracking. There's inventory missing from the well site that has been billed, and subsequently credits are missing and procedural issues are evident. Overhead concerns, we did touch on that again from the operator's perspective. From the non-operator's perspective, you can do reconciliations and on the drilling, producing, and also the review procedures for the joint operating agreement to identify what you should be charged. And what we're seeing is there are some overcharging of drilling days. There's undercharging based on the well status. Temporarily shut-in properties are getting charged. So, from a production overhead perspective, if they didn't have any production in a particular month, then they shouldn't be charged for that month. And then then there's also covered by overhead charges. So things that are basically directly charged to the well, but should be covered in overhead or by overhead according to the joint operating agreement in place. And then shared pad concerns. We are seeing a lot of operators working really hard and diligently on getting this right, and it is an area that has come up newer since the shale play and the shale booms. And I know COPAS worked really hard on their AG around shared pad costs, and it's an area that we see can continually be improved, and we're seeing that findings have happened in this area because sometimes there's different interests in different wells. So if you're on the same pad and you're just billing everything out, without any kind of basis or reallocation, then there's going to be problems with that when it comes to the non-op working interest. Road location costs, equipment costs, gathering lines, and well pad construction costs. Those are all costs that get pulled and allocated. And sometimes allocation just doesn't happen, so it hits the first well and then it just doesn't get reallocated. Owner interests, again, vary, and then refunds and charges that are due to the well can be wrong. Also, those costs that should be flow through to future wells by making sure you have a good allocation pool and good support in that allocation pool, that will help in the process. So our processes are still lacking in this area, but I feel that they're improving and hopefully will continue to improve. Insurance concerns. This one has been kind of a big one on our radar this year, more than previous years, I think, just because we're seeing a lot of discrepancy in what the agreement says and what insurance is getting billed out. And some of that has to do with allocation, and it, again, is going to be based on the agreement. So if you're not, if the operator's not factoring in what the agreement says and they're pulling all their insurance for all their properties in the U.S. and then they're allocating them, then that's generally probably not going to be an appropriate way or methodology. There are some creative agreements out there when it talks to insurance. So, again, looking at those agreements, making sure you're aligning your accounting with that will be helpful, and that's just something I wanted to bring up in terms of insurance being an issue. Vendor concerns, we did talk a lot about that from the operator perspective, and again, it's a concern from the non-op as well. I think that it's a valid concern because support and allocation of these invoices. Operators do a lot of business with vendors, and it's pretty easy to get invoices to go to the wrong well. So, just making sure that those are figured out, identified in the audit process, and exception is addressed by the operator, that's helpful. And I like it when it, kind of helps the operator as well when we find those vendor issues. Generally, on our joint venture audits, I'd say just processes, and I think we talked about that earlier, but processes, reconciliations, allocations, how joint interest billings are conducted, and support. I think that can't be stressed enough, is making sure you have good documentation and support for charges. Also, what people are you using to address auditor requests? Are they the right people? Does it make sense for your organization to maybe consider somebody that may be more technical, or depending on what it is you're dealing with? I know a lot of times we'll try to address issues with somebody that may not kind of be up to speed with COPAS or with what's required, and maybe they're just a conduit. But I think the more you can put somebody in place to address auditors' requests that maybe know a little bit more about the processes and requirements of the JOA and the jibbing, it would be helpful. There's a knowledge gap in the industry right now on COPAS. Some of that has to do with new entrants, people that are new to the industry and they need to get up to speed. And that can be a problem, and especially when a joint venture auditor is trying to get things accomplished and just getting that knowledge in place, I think from the operator's perspective is prudent and helpful when you bring new people in. Accounting policy misalignment, that speaks to the accounting policy of the operator deciding to bill out certain things a certain way when all the JOAs don't necessarily agree to that. So when there are outliers, making sure there's some sort of process in place to deal with those outliers. And then relationship building, I think, is one of the most important aspects that come out of a joint venture audit, is making sure that your non-ops and operators are communicating, they're understanding what their concerns are, what the issues are, and addressing those going forward so that they can have a successful venture and good economics. COPAS energy education. This is something that COPAS has spent a lot of time on in the last few years, developing some very good courses and framework that are NASBA certified, and webinars are out there and available. There's also trainers that are available to come to your site to help you and your organization learn more about the COPAS publications, learn more about how they should be applying certain things and accounting for certain things, both from the JIB side and the revenue side. And they are also open to, formulating education that's really going to be more towards your organization. So give COPAS.org a try if you're looking for education. And also there's a new foundation that COPAS has set up. It's the COPAS Education Foundation. It's a 501c3, and now individuals can actually contribute to that. And I think from a industry perspective, as we look to keep our skill sets relevant, and if we have organizations that support matching 501c3 contributions, it would be a great consideration going forward to make sure that COPAS continues to be at the forefront in this industry and addressing the issues that need to be addressed and educating.
Okay, so our next polling question. COPAS Education Foundation provides educational opportunities for accountants in the petroleum industry. True or false?
All right. I don't see any falses, so looks like everyone was listening. Thank you. And we'll get into the last phase or last objective of this webinar today, and that's establishing a consistent JV audit program. And I think by establishing a consistent JV audit program, you're going to have benefits over the long term, because all of the issues that come up, instead of waiting till somebody just asks and doesn't know what's going on with an agreement, and then everybody comes out of the woodworks and gets upset about what's going on with the joint venture. We've seen that a lot, where they've never audited, and all of a sudden, no, we've got to have an audit. I think if you start a practice of a joint venture audit program to be continually something that is going to happen and that the operator knows about, it really smooths things out with the partnership, and you can be on the same page and move forward in a good way. So what are joint venture audits? They're basically taking the audit rights that you have, and they're definitely agreement specific, making sure that you are executing those rights. There are COPAS publications that we've talked about, and I'll continue to keep addressing, that's the go-to area, but the preparation, testing and field work and reporting, COPAS AG 19 just got revised, and that is on the expenditure side. Council approved, and we've got a new form coming out there. So COPAS e-publications, that's something you want to have. All these publications are integral. You don't want to just have one. You need them all in order to have the right picture of how to do the joint venture audits and what's expected from an industry standpoint and agreed upon. The objectives of a JV audit. The objectives are basically to identify if there are exceptions. So keep in mind that a non-operator is, per their agreement, they have to just pay their bill. They have to do it basically as they get billed, and they have this audit clause in place in order to make sure that they can address any concerns or questions with their billing. However, they're not precluded from asking an operator while the billing process is occurring what's happening and what's going on. It basically rounds it out at the end of the day to determine whether or not there are exceptions, the billing is correct, and you really can't have a good look without having a joint venture audit done. It's also the objective to report the exceptions and report them within the time frame allowable per the agreement. So you want those on record, you want those addressed, and you want them to be agreed upon to the terms of what the partners can come up with and what they believe is right. And if they need to make modifications on a go-forward basis, maybe that's one of the outcomes, and it'll help the relationship going forward. Some of the best practices in joint venture audit, again, setting those partners' expectations, letting them know up front, hey, this is going to happen. It's going to happen, on this periodic basis, and here's what to expect, and we can make sure we're aligned with your schedule and all the partners are in agreement. So it'll improve those agreements between the partner, helps maintain the consistency of those audits, maintain the pulse, and the scheduling aspect, I think, is really core when it comes to getting on the operator's schedule, making sure that it keeps the costs of the audit down from both perspectives, and it helps the partners maintain the involvement and resolve the issues and get the results that will ultimately drive the economics of their properties and their wealth.
Our next polling question, is it beneficial to maintain compliance efforts with your business partners on a consistent basis? Yes, no, or not sure? All right. I think there's all yeses there. So, I think we're in agreement. It's good to have that expectation set up front, and that you've got a consistent process in place to help facilitate it. What are the auditor's goals? When we're out there, it's to identify the concerns, to articulate those concerns, and ultimately to resolve those concerns. And we'll talk about some results that we've had, but in resolving concerns, it's nice when an operator can basically see the issue and address it there on the spot, and also affect the JIB process. So when they're able to basically apply the credit and get it into the JIB process, then that makes everyone happy, and that deals with the issue right away. We'll do that. We'll do in our report process, we'll basically identify that it's been agreed upon, how much, and we'll say what JIB date that the credit came through. Then there's no
real back and forth on the operator or the non-operator side. It's resolved. What are the joint interest partners' goals? I think at the end of the day, they're the same as the operator. They also want to review operations, and they want to resolve the concerns that come up during the audit, and that the audit concerns are typically aligned with that partner's concerns, and get the resolution and move forward in their joint venture. So some of our findings. I have a little disclaimer at the bottom. We're going to disclose some specific findings that we've had, and those findings relate to these areas. They also will give you a sense in terms of resolved exceptions. So, you might have a joint venture audit or JV audit, and there's a lot of exceptions taken, but some of those don't end up getting resolved, or they don't end up getting figured out. So the way that I've structured the next few slides will be basically, what did we get agreement on? What, at the end of the day, were we able to, figure out or conclude, and what was the conclusion? Sometimes if there's a sticking point or an issue and it really is a problem between the non-operator and operator, that kind of goes beyond the scope of the audit, and they'll be dealt with in mediation if need be. But what's nice when you're able to really have good articulate findings and articulate the findings and agree upon them, it's helpful, and it also kind of puts it to bed and puts it to rest and lets you move forward more quickly. So the Bakken area, this is just an example of the average cost, because we talked about earlier in this presentation what the cost on the footage is. And this one particular well was this particular audit averaged about 19,000 feet, and the cost was about $9 million for the well. The cost per foot was about $500, and the exception per foot was about $1.17. The granted per well, and this is granted. This isn't any of the pending. There's definitely pending exceptions that stick out, but the amounts that were granted were $22,000 for the average well. On the Marcellus and Permian Basin, on our audit findings there, we've dealt with gathering assets and revenue allocation issues, drip, that sort of thing. So in these areas, we've found recoveries ranging from $65,000 to $1.2 million. So it's variable, in terms of what you find, but there's a lot to be, I think, considered when it comes to your gathering and your revenue, and how that's being performed from the operator's perspective. So without taking a deeper dive and look through the joint venture audit process, you just don't know what those areas are. In Niobrara, we had about 11,000 was the average foot. The average cost of the well was about $4 million. The cost per foot, $360, and the exceptions per foot was $1.60. And we identified a grant of $18,000 about per well. Eagle Ford, the average footage there, $16,000 for the well. The cost of the well, about $8 million. The cost per foot was $500, and exceptions was about 36 cents. So about $5,000 to $6,000 per well in the Eagle Ford for this audit example. And then offshore Gulf of Mexico. Offshore is a different animal when it comes to joint interest audits, there's a lot of money out there. I mean, a lot of costs that get allocated and jibbed out, and the agreement becomes all important, and how these allocations are happening, credits that are needed. We identified $1 million to $1.5 million in credits that were missing. Long lead inventory, about $500,000 to $800,000. Costs covered by overhead, $100,000 to $200,000, and overcharges of $90,000 to $900,000, and that's just per exception. Miscoded charges, $15,000 to $130,000, and off-site technical labor that was covered by overhead between $5,000 and $300,000 for our exceptions there. And essentially, to round out the findings, is just there. You just don't know what you don't know until you get in there. And I think that some ways that it's helpful that we take a team approach as we basically work with our clients, and we make sure that they're on board with how we're proceeding, and that we're aligned with what their concerns are. So scheduling concerns, making sure that we are scheduling our audits consistently is helpful. Now, I want to bring up here that sometimes we hear people say, hey, what about COPAS rates? Well, COPAS rates were actually established to help when non-operators participate with other non-operators in an audit. So let's say one non-operator has an accountant that's available for a couple weeks, and they want to send him on the audit. Well, then they use COPAS rates to reimburse that non-operating company to help facilitate the audit. Consulting rates are different, and COPAS rates were never meant to be market rates. They were meant to help with the other non-ops in the participation effort. So, that's just something to keep in mind when you're going out there and looking at getting consulting costs and trying to find the value of the audit. It's really shouldn't just be focused on COPAS rates. That's something that is a misnomer, and I really wanted to address that here. The value of the team approach, I think, is really important when you have a consultant, that they are taking a team approach, that they're including you in the important questions, that they're not rocking the boat, that they're not just throwing spaghetti at the wall to see what sticks. That can really hurt your relationship at the end of the day with the operator, and that's not what we do here at Hein. Is we're here to help facilitate what you really need. And what can we, what are the audits? What are the, rights of the audit? You're limited typically to 2 years on the expenditure. Sometimes an operator will allow for extension on that if there's good reason and there's some important things that need to be addressed. Revenue audit, I think it depends on the statute. It's really not specified in the JOA typically. And then we're seeing clients engage frequently and consistently, and we're also seeing clients get a good ROI on their JV audit investment. And audit results, having supportable findings, making sure that you have agreement with the operator, and I've already touched on a lot of this in the last few slides.
Okay, the last polling question. Hein offers JV audit as a service to clients, expenditures, revenues, vendor audits, gathering, offshore, onshore, etc. True or false?
All right. Well, that was everyone answered true there, and that is the case. And so you are listening, so congratulations. In closing, operators continue to take action because they're basically getting audited. They're becoming targets for a lot of audits, and so taking action now is going to help when audit findings and audit things come up, and they're embracing improvements. Further uptick is anticipated this next year. Our prices have not reached the levels they used to be at. Costs continue to be a concern. Transparency continues to be a concern. So I feel that there'll be further uptick. And then joint venture audit programs, your choice of consultant is important. Your programs are essential in protecting your assets, and having consistency in your program will help lead to improved asset economics. So with that, we'll open it. Thank you, and we'll open it to questions, I guess, right?
Yep. Now we would like to give you all a chance to ask some questions. If you do have a question, please submit the question via the chat box in the bottom left corner of your screen. If we don't get to your question during the last 10 minutes of the webinar, our presenter will follow up with you via email. We actually have one here. It's kind of lengthy, so give me a moment to read it. Section 5 in the typical accounting procedure joint operations document says that a non-operator, upon notice in writing to operator and all other non-operators, shall have the right to audit operators' accounts and records relating to the joint account for any calendar year within the 24-month period following the end of such calendar year. What type of notice is typically delivered to the operator? Does it need to be well specific, or just a notice that we have the right to audit? Would we just use the title opinion to determine other non-operators?
So we have a standard form that we use and we provide to clients. So if you're interested in what our form looks like, feel free to reach out to me. I can give you a template. But we typically ask our clients to put it on their letterhead, and we do think that it's important to specify the area of interest in terms of, depending on how much you have with that operator, how many assets, they need to know what assets you're talking about as well, because they may have a lot of other non-operators in their area. So I encourage well specific if possible, unless it's the relationship such that the operator just knows what you've got, and that they can just handle it that way. So hopefully that answers your question.
Okay, another question here. Should I participate in a JV audit, and what happens if I don't? Won't I still see the benefits?
And we get that question a lot, and that's something when I first got into the industry was interesting, because I was in a non-op area. Basically, my company was non-op, fully non-op, and we'd see these things come through that said JV audit or JIB audit or whatever, and we'd see credits come through. So I think you do see some of the credits, but what you don't see is those that may be more the issues that are the bigger issues. So if you don't participate, you don't get that report. You also don't necessarily get resolution for some of the bigger concerns. So really, I think, at the end of the day, the cost to participate is usually nominal, and you're going to find that the insights are going to be helpful when you're moving forward with that operator.
Okay. Next question. My company doesn't have the highest WI % in the well, but we really want to audit it. How do we go about doing this?
Okay. And WI is working interest percentage, and they don't, if you don't have the highest, you can still audit. You typically want to go to the highest working interest owner to get the rights. So you would call them and say, are you planning to audit, or can we participate in the audit? If you're not planning on auditing, we'd like to audit the well, and you can then ballot other non-operators to take part in it and get the lead audit rights in that particular audit.
Okay, next question here. How far back can operators bill non-op partners with charges, D&C, facilities, etc.?
So operators are typically limited to the 2-year limit, but when it comes to controllable equipment, they can bill beyond that if there's, good support and documentation to do so. So I think that, basically you're going to see some things get billed that are within the 2-year limit and some things may not. But when that happens, I would just question them as to what's happening there and why they think they have the right to bill that. And don't pay it, if it looks like it's outside the 2-year limit until you've gained resolution to what's going on there.
Okay. What recourse does our company have if the presenting findings are not settled by the operator?
So what we find is that if there is an issue and it just cannot be resolved, the JOA does have procedures in place for arbitration and that sort of thing. So that's typically where we'll go if you guys can't figure it out.
Next question here, what reasons other than cost recovery would I have for conducting an audit?
A lot of reasons, and you would want to talk to probably your higher ups, your C-suite, as far as what are they doing. If you have a non-op stake in an area, there may be a reason for that. You may want some insights into what's going on with certain vendors, with what are they billing you as an operator versus the other, and that gives you some insight into costs. It also kind of helps facilitate some other intangibles, if you will, enlightens the company and the organization. So I would get your ops folks involved in terms of what is it that you want out of this audit, what ultimately are you looking to achieve.
All right, and then we have one more question. My company did not sign a JOA, but we have been paying the bills and collecting the revenue. Can we still audit the operator?
Well, we're typically seeing that type of scenario in North Dakota because a lot of companies went out there without title opinions and they went ahead and drilled. And we've been successful auditing those. The JOA, there are a lot of companies coming back and trying to get to the table and get these JOAs executed, but the state of North Dakota has certain statutes and laws in place to facilitate still being participants in that even without a JOA. So I think an audit is definitely a doable thing.
All right, thank you, Deanna. That's all the time we have for questions. Please be sure to check your inbox for a follow-up email with an evaluation form that must be submitted in order to receive your CPE certificate for the course. Thank you all again for attending today and have a great day.